most investors learn from reading textbooks, and most of the textbooks about quality investing are very comparable, and they tell you to look at companies and analyze them through a lens of competitive advantage. And it's really about finding companies that have large competitive advantages, or in the industry parlance, wide economic moats. So that could be, lots of scale, strong brand, intellectual property, big bargaining power with buyers and sellers. And our view is different. Our view is competitive advantages are not static. Things change. There are forces working for a company, against a company, and it's really the direction of that competitive advantage, not the size of the advantage, that drives stock returns. So we'd much rather own a good business that's becoming great than a great business that's becoming good. And you can think about it, technology is the easiest way to kind of illustrate that point. If you go back, 15, 20 years ago, you look at the who's who of technology companies, many of them don't exist today, or they exist in much, smaller forms, like companies like BlackBerry, Nokia, Dell. Easy to kind of, in hindsight, poke fun at these companies and where they've ended up. But, back in that day, they were the paragons of quality and technology, right? But what I think investors missed is they were becoming less great companies over time. Their moat trajectory, as we call it, was negative. I think investors tend to underestimate the damage that can be caused when a company's competitive advantage is shrinking. It's not a slow bleed. Usually, it's generally a sharp decline, especially in technology. So really keeping that bar high and owning a portfolio of companies whose competitive advantages are growing, that's the name of the game for WCM. One of the investments we exited, recently is a company called Activision. It's a video game company. And our original thesis was, the scale players are in a good shape in that industry because the cost of game development is rising. There's things like connected gameplay, digital gaming, and all of these kind of new themes are helping kind of the existing large companies who have big budgets and, existing large franchises. I think things changed pretty abruptly in the last 2 years, where you had the emergence of games like Fortnite, free-to-play gaming, social gaming, and really the relevance of some of the advantages of the big companies was steadily diminishing. So it's not to say these businesses won't continue to be good businesses and can churn along, but for us, again, we're trying to keep that bar very high. So we find it hard to think that those economic moats, those competitive advantages are still growing. So that's enough for us to exit a position. We're not a manager who'll wait for evidence that the moat is breached. I think if you're in the growth camp and you're waiting for that signal, it's far too late. There's irreparable damage done to the stock and the portfolio.